Welcome to the Global View on this Tuesday. I'm Andrew Gagan. Good to have you with us here at ausbiz. So let's check what happened overnight. Stocks on Wall Street taking a breather after six straight weeks of gains ahead of earnings reports due this week, which could prove to be critical. Just taking a look at see how the major indices finished there. As you can see, the Dow and S&P finishing negatively. However, the Nasdaq managed to buck the trend. Most rate-sensitive mega-cap tech stocks slipped, with Tesla down 1.3, and in fact it was a little less than that, and Microsoft managing some gains there. The rate-sensitive real estate sector was the worst performing, but the tech sector was lifted by a 3% jump in Nvidia. Actually ended out more than 4%. Meanwhile, Boeing jumped after news that workers could vote on a new deal to end a costly 5-week strike. And after a fairly upbeat start to earnings season, the focus is on more than 100 S&P 500 companies scheduled to report this week, including Tesla, Coke, and Texas Instruments. Well, global bond yields rose as market pricing for a central bank easing was pared further. The US two-year Treasury yield rose to, from 3.9 to 4.03%, while the 10-year popped from 4.08 to 4.18%. Markets pricing an 85% chance the Fed funds rate will be cut by 25 basis points at the next meeting. And the US Conference Board leading index fell 0.5% to the lowest level since 2016. Meanwhile, Fed Reserve Bank Dallas President Lori Logan said she sees more rate cuts ahead for the central bank and suggests she sees no reasons why the Fed can't also press forward with shrinking its balance sheet. Whereas the Fed's Neil Kashkari said job market weakness could mean faster rate cut pace, while we also heard from another Fed member in Rafael Bostic, who said he sees no need to rush on rate cuts. Well, the US dollar climbed. The greenback has risen for 3 straight weeks and 14 of the past 16 sessions. And the Aussie is down to 66.5 US cents. Elsewhere, home sales, flash PMIs and durable goods reports are on the data docket through the Fed's week, as is the Fed's beige book. Checking in on commodities, oil advanced, recouping some of last week's more than 7% decline, with no let-up in fighting in the Middle East. Iron ore moved higher, while gold eased a little after surging to a record high, and high yields and the US dollar offset support from growing uncertainty surrounding the US presidential election and the Middle East war. And Bitcoin did come off its recent highs. They're now falling below 68,000 US dollars. All right, let's get across everything we're seeing, particularly on Wall Street at the moment. Steve Sosnick joining us from Interactive Brokers. Steve, good to catch up with you. Well, look, the markets can't keep going up and up, can they? We need to take a breather at some point. What did you make particularly of that session just gone? Interesting that actually wasn't the tech stocks that led those losses, despite the fact that we're heading into a really critical period in earnings.
Good morning, Andrew. Great to see you again. Yeah, I mean, I think it was kind of fascinating that that we pretty much had a very broad sell-off. I mean, rates really went up. There wasn't really much of a consensus as to why, more of a series of negatives, minor negatives that added up to a big down day for bond prices, higher day for bond yields. But this, the tech sector isn't really, it's interest rate sensitive when bond yields go down. It's not interest rate sensitive when bond yields go up. It's just going to do what it's going to do. And the momentum, particularly in Nvidia, remains very strong. We had all the sectors down in the S&P 500 with one exception, information technology, which is semiconductors and friends. And you know what? My premise has been, as go the semiconductors, so goes the markets. And today it didn't quite work out, but say the rally in semis, and particularly Nvidia, certainly salvaged the day for the market. What you see there is a chart I'd sent you, basically showing this premise. Obviously, that's SOX on the candles, and that big drop was ASML day when ASML dragged down the market. But then the next day we had Taiwan Semi push up the market a little bit. And you could see the S&P and the Nasdaq went higher. The following day, all three went down. On Friday, you actually had a little bit of outperformance from the broader indices, and today today largely they tracked each other, and I will say again that that SOX has more or less kept the market up. The correlations are are really quite high considering it's one sector. But at this point, the sector keeps growing in size and importance, and so that's enough at least to turn today to a very modest declining day on the S&P. When you had 3 to 1 negative, 3 to 1 decliners as opposed to advancers.
So, Steve, overall, would you say that uptrend still very much intact? Short term, though, that directional bias pretty much hinging this week at least on some key results, particularly from Tesla, Alphabet, and Amazon.
Yeah, now we're getting into really the teeth of earnings season. We're getting, this is, this week and next week, and to some degree the week after, are the biggies in terms of, in terms of just number of stocks and size of stocks. And after I just went all that way about Nvidia, they're sort of off cycle. They're not for another 4 weeks or so. But other than that, the next couple of weeks, we're gonna get everybody who you think we're going to get, and then some. And this is really going to be the key. And my key here is not so much, don't necessarily look at whether the stocks are beating their EPS numbers. In an environment where 80% of the stocks beat their posted EPS, that's no longer a sufficient condition for a rally. It's a necessary condition. But ultimately, when you think about it, we're pricing in about 15% growth. We being collectively the market, and that's what's priced as the S&P 500. About 15% growth in earnings for the S&P 500 in the coming year. So what really matters is whether we can deliver that. When you're at a PE that's in the 20s, you better deliver on your guidance, and that's what the markets are going to be looking for, rather than looking at EPS, which tells you at best the present, at worst the recent past. They want to hear from companies what they expect for the future, and let's see what they have to say, because that to me is really going to be very key. The ASML situation and the Taiwan semiconductor situation basically prove that, where ASML had good EPS but disappointed on guidance. Taiwan Semi had good EPS but gave good guidance, and that you had the divergent results.
Steve, you mentioned the US 10-year, that climbed along with the US dollar. Is that perhaps an indication there, the market seeing that US economic exceptionalism, if you like, but also the Trump trade is back?
It's any number of factors. I mean, right now, neither candidate is particularly talking about any sort of fiscal discipline. I would say the former president is probably a bit more prolific because he seems to be passing out, tax cut proposals to everybody. Um, I don't know to what extent the Trump trade is back. It certainly is if you look at prediction markets, and I say this, considering Interactive Brokers has a prediction market of its own now, IBK, our forecast trader, and we've seen the movement toward the former president Trump. It's about 58-42 when I looked just before coming on air, but the problem we have here is, and there's been some reporting by the Financial Times and the Wall Street Journal, that the bigger money is going toward Trump in terms of the prediction markets. And these are small and to a large extent untested. And so it doesn't take that much money to move the prediction markets. So, but I do think as that gets baked in, as that sort of is presented in people's face, if you present market data to people who live and breathe markets, that's going to come into play. And I do think that is some aspect of why you see rates rise. But it also just seems to be more that periodic fear that we get, that oh, who's going to pay for our deficits? This comes about every few months or couple of years, and that seems to be what's going on now.
It's all right, just keep kicking that can down the road, Steve. We'll work it out eventually, maybe. We've also spoken in the past, of course, of geopolitics, and you've made that point that it doesn't really move markets, particularly in the States. However, are we seeing something of a cumulative effect, if you like, of now weighing on markets, and then throw in, of course, the US election?
I do think that's fair, yeah, because I think that there's not necessarily one thing. There's the election, there's the Middle East, there's the China stimulus. All these things fall under the geopolitical. Maybe the China stimulus is more specifically economic. And what it means though is markets don't really know how to price that. They're still not very good at this. I alluded to all the reasons that they may or may not be right in terms of the prediction markets and following them. Um, but I do think that is kind of what's weighing on the situation in terms of bonds and to some and oil, although oil isn't really that afraid of the goings on in the Middle East right now. I think they're more concerned about the China economic situation. But you've heard me say it before. Watch bonds, watch oil if you want to know what's going on in terms of geopolitics. Don't watch the stock market because, especially now, because quite frankly, people are going to buy Nvidia no matter what happens.
Well, I
It seems
mean,
so.
can you throw gold into that as well? Obviously, given it
Yes.
keeps hitting new records.
Yes, but gold has its times where it acts as a geopolitical hedge. Other times it acts simply as the anti-dollar. Right now, I would argue it's more of the geopolitical hedge since it seems to be going up at the same time that the dollar is showing strength against a range of currencies. So in this case, I would say it's sort of either some kind of inflation or fear proxy. But there are other times where markets aren't, where there really isn't that much going on, and you start to see gold as just gold is sort of the opposite of the dollar. I call it the anti-dollar. And I do think that the anti-dollar mantle has shifted to cryptocurrencies. So to some extent, I do think you're correct in saying that gold is reflecting um, concerns, whether it's inflation or whether it's geopolitics. It's always tough to separate that out, but that is a very fair point. Yes.
Steve, as always, terrific to get your analysis. Enjoy your week ahead. Thanks for joining us on Interactive Brokers.
Thanks so much, Andrew. Talk to you soon.
Let's check the local market just before we get underway, and we are expecting a sizable move lower when we get going. SPY futures there down by 0.8%. Stay with us because the open is just a couple of minutes away.